Equity markets are at a record high. The Fed is lowering rates. Working class people live check to check, and there's insecurity throughout the system. Tariffs have not been helpful to adding security. And of course, there's an election coming up in 26, the midterms. So there are a lot of policy changes that are afoot. This is an interesting, complicated time in our economy. Is there real growth? Hard to tell when the federal government was shut, and we haven't gotten actual statistics from the Bureau of Labor and Statistics. So it's a fun time to be a professional investor. It's interesting, revenue growth and EBITDA growth are there. So we're seeing businesses continue to perform. The cost of capital remains elevated. So how businesses roll their debt that's now maturing from the COVID era. Think about a 5-year loan in 2020 coming due in 2025, 2026. It's a very interesting time. We're seeing some fundamental performance, but the forward outlook is uncertain, and we're seeing hiring start to slow down. At some level, we're transitioning from a pyramid economy to a diamond economy. That bottom tier, as a result of AI and uncertainty, is not growing at the same pace that we've seen historically. Inflation. It's all about the grocery store and being able to pay for your kids' tuition or after-school activities, not to mention food on the table. We're seeing cost inflation across the board, and wages are not keeping up. It's the fundamentals. On the one hand, the BDCs who have the lowest cost of capital have a strategic advantage. So earning a low borrowing cost for your vehicle is the most efficient way to add value to your portfolio companies, because you're in a position to make capital available at a reasonable price. But not all BDCs have a low cost of capital. We're seeing a dispersion of cost of capital among BDCs. The second is to actually honor the original intent of BDCs, which is to deliver capital and managerial assistance to small business. There's a window here where, because of inflation and tariffs and economic uncertainty, private credit can partner with small business to actually reduce turnover and increase healthcare and retirement benefits for workers, all of which can be tracked and measured and reported out to regulators. At Lafayette Square, we think about AI used to analyze large data sets regarding workers, payroll data, healthcare and retirement enrollment data, zip codes where workers actually live, and bring tailored solutions that, again, aid workers in reducing turnover, increasing productivity, boosting retention, driving better outcomes for the enterprise, which of course helps us as a capital provider. The industry starting from ground zero. Managerial assistance has not been a real thing for BDCs for decades. And this is the environment in which we can make a difference. As an industry, we should band together and actually create value for portfolio companies, for borrowers, by reducing their turnover, increasing their retention, helping their workers where they live with healthcare and retirement that actually meets the moment.